current price of Puma SE is trading at €19.79, seeing a massive intraday surge of plus €2.79, which translates to a staggering 16.38% gain on the German Xetra exchange right now. The charts are effectively vertical at this moment. If you were watching the order book, the volume is flooding in at a pace we haven't seen in this ticker for the better part of 3 years. We are looking at a breakout candle that has completely engulfed the previous week's trading range in a single afternoon session. This kind of price action forces us to stop and ask the uncomfortable question: is the market finally correcting a massive undervaluation, or is this a trap? The expectation for Puma throughout most of 2025 has been bleak. The narrative has been one of a dying brand, squeezed out by Nike's dominance and Adidas's resurgence, leaving Puma in a no-man's land of sportswear. Too big to be niche, but too small to compete for the podium. Investors have largely treated it as dead money, a value trap that keeps getting cheaper but never actually offers value. That was the expectation. The reality, however, just shifted in the last 4 hours. This isn't just a technical bounce from oversold levels. This is a repricing event based on credible reports that the sharks are circling. We are no longer looking at a standalone footwear company struggling to sell inventory. We are looking at a potential acquisition target that has just been put in play. The gap between what the market thought this morning, that Puma was a declining asset, and what the market thinks now, that it is a strategic asset for a global conglomerate, is where your opportunity lies. When you see a move of 16% in a large-cap German equity, it is rarely retail traders on the Robinhood app waking up and deciding to buy sneakers. This is institutional heavy lifting. The rumor mill is currently pointing toward significant interest from Chinese sportswear giant ANTA Sports and potentially others who see the current battered share price not as a warning sign, but as a discount tag. If you are sitting in a Fidelity brokerage account or managing your own individual brokerage portfolio, you need to understand that merger and acquisition rumors change the fundamental math of a stock instantly. It shifts the conversation from what is the price-to-earnings ratio to what is the strategic premium a buyer is willing to pay. Let's look at the broader context of why this is happening today. For the majority of this year, Puma stock has been decimated. We are talking about a stock that is down significantly year to date, trading near 52-week lows just yesterday. The sentiment has been so poor that even Schwab Intelligent Portfolios and other SoFi robo-advisor algorithms likely began underweighting the consumer discretionary sector in Europe specifically to avoid exposure to names like this. The company has struggled with inventory bloat in North America and a lack of brand heat compared to the terrace culture revival that boosted Adidas. But today's price action suggests that the floor is in. The sheer volume of shares changing hands indicates that a large entity or a cluster of hedge funds is positioning for a formal offer. Comparing this to other high beta names, the volatility we are seeing today is reminiscent of the early days of a Tesla stock rally, or the sudden sentiment shifts we often see in Nvidia stock when a new chip is announced. However, unlike Nvidia stock, which moves on earnings and growth, Puma is moving on event-driven speculation. This is a dangerous but lucrative game. If you are engaging in online investing or using interactive brokers' trading platforms to access European markets, you have to be aware that this €19.79 price level is a battleground. The shorts, who have been riding this stock down from €40, are currently being squeezed. They are forced to cover their positions, buying back shares at any price to stop the bleeding, which adds fuel to the fire. It is critical to analyze the why behind the what. Why would anyone want to buy Puma? Despite the poor stock performance, the brand remains one of the few truly global athletic icons with a heritage that dates back to 1948. In a world where self-investing is becoming more popular and people are looking for tangible value, Puma offers a massive distribution network and a legacy that is hard to replicate. You can build a new shoe brand, but you cannot build 75 years of history overnight. The reported interest from ANTA Sports makes strategic sense. They have the capital and the dominance in Asia, but they lack a true global foothold in Western Europe and the Americas, something Puma provides instantly. This is why the stock is up 16%. It is not because they sold more shoes today than they did yesterday, it is because the asset itself might be changing hands. For those of you who use SoFi active investing or Robinhood fractional shares to dip your toes into these volatile waters, you need to look at the ownership structure. A huge chunk of Puma is owned by the Pino family via Artemis. Their willingness to sell or hold is the single most important variable here. If they signal they're open to a deal, this 19.79 euro price could look cheap very quickly. If they shut it down, we could see a rapid reversion to the mean. This is the tension I mentioned earlier, the expectation of a deal versus the reality of family-controlled European corporate governance. Let's step back and look at the technicals on the chart. Before this news broke, Puma was forming a classic descending wedge, a bearish pattern that usually suggests further downside. However, today's candle has shattered that upper trend line. In technical analysis terms, this is a breakaway gap. If you look at your Fidelity trading platform or even the charts on SoFi Invest, you will see that the price didn't just drift up, it teleported. The Relative Strength Index, RSI, which had been languishing in oversold territory for weeks, has now spiked. This indicates momentum, but it doesn't necessarily mean it's overbought yet because the catalyst is external. It is not a natural market cycle. It is a news event. Now, I want you to pause and think about your own exposure. Comment below how many shares of Puma stock you currently hold, or if you are holding competitors like Nike or Adidas. I want to know if you think a Chinese acquisition of a German heritage brand will actually be allowed by regulators. Drop your thoughts in the comments section. We need to discuss the business model briefly to understand what a potential buyer is actually getting. Puma operates on a wholesale and direct-to-consumer hybrid model. Historically, they relied heavily on wholesale partners, think Foot Locker or Dick's Sporting Goods. This is great for volume, but bad for margins because the retailer takes a cut. Over the last few years, Puma has been trying to pivot to DTC, selling directly through their website and Fidelity mobile app integrated stores or their own physical locations. This transition has been painful and expensive. It requires massive logistics investment, something that has weighed on their balance sheet and frightened off the conservative money in Fidelity mutual funds. But if a buyer like ANTA steps in, they could potentially streamline this supply chain using their own massive infrastructure in Asia, instantly unlocking margin expansion that the current management team has failed to deliver. The comparison to peers is stark. Adidas has successfully navigated its own crisis, the Yeezy fallout, and has come out stronger. Nike has been in a restructuring phase but remains the 800-pound gorilla. Puma has been the laggard. If you check the Interactive Broker stock data for the sector, you will see capital flowing out of Puma and into Adidas for the last 18 months. Today is the first sign of that flow reversing. This rotation is crucial. Institutional managers who run Schwab Intelligent Portfolios or Fidelity ETFs often rebalance based on market cap and momentum. As Puma's market cap swells by nearly 20% in a day, these passive funds are forced to buy more shares to maintain their weightings, creating a secondary layer of buying pressure that has nothing to do with the news and everything to do with math. There is also a macroeconomic angle here. The euro has been fluctuating against the yuan and the dollar. A weaker euro makes German companies like Puma cheaper for foreign buyers. This is a classic arbitrage play. If you are an American investor using Robinhood investments or SoFi stocks, you might not pay attention to currency crosses, but I guarantee you the M&A teams at major private equity firms do. They see a depressed asset priced in a weakening currency, and they see a bargain. But we must also address the risks. The reality part of our equation could turn sour. Regulatory scrutiny in Europe is at an all-time high. The European Union has been very protective of its strategic industries. While sportswear isn't exactly defense technology, we have seen increasing protectionism. If the German government signals that they oppose a foreign takeover, this stock could drop 20% as fast as it rose. We saw similar volatility when rumors swirled around